All right, we'll go ahead and get this started. I didn't realize we were as late as we were. So, thank you very much, everyone, for joining today. My name is Alex Perny. I will be your moderator for the Power of the Solo 401k today. We're going to be going through a good amount of details today on how the Solo 401k compares to other types of employer type retirement plans. But feel free to ask any questions that you have, even if they aren't necessarily directly pertaining to solo 401ks. I am more than happy to answer any of those questions. My direct contact information is right here. Again, my name is Alex Perny. I've been with Advanta for going into my 8th year now. Really enjoy what we do, enjoy helping people kind of realize the additional options that they may have, and really help to peel back the layers and the mystery of these types of plans, as they can be kind of daunting if you just read it on paper. There's a lot of information that goes into these, and there's a lot of things that people might get a little bit apprehensive about, but we're here to help. We're here to kind of demystify it and make sure that you understand what might work well for you as a self-employed individual, or if you have a side business, or if you're just an investor looking to help defer some of that taxation that you're going to be hit with while making money in your endeavors. Please do make sure that you do type in any questions that you have. I will monitor the chat box as they come up, so please do type in your questions. I will address those. And again, even if they aren't necessarily salient to exactly what we're talking about, I am more than happy to answer those as well. So a little disclaimer before we get started: Advanta IRA and our employees, we do not provide legal, tax, or investment advice, nor do we promote or endorse any investment products. All information and materials are for educational purposes only, and all parties are encouraged to consult with their attorneys, accountants, financial advisors, and other qualified individuals before entering into any type of investment. So a few key points to take away today. What kind of accounts work best for certain businesses? The different ways to administer 401k accounts, and the reason behind the different plans. Because when we talk about solo 401ks, in a broader context, we're talking about retirement plans for a business. Now, IRAs, aptly named individual retirement arrangements, are for you, the individual. And business plans are going to be for those people that either are self-employed, have a small business, or obviously can scale up from there. People are probably at least conversationally aware of what a 401k is and the fact that you have two different parts of the contributions that go in there. But we're going to try to delineate that a little bit farther with that. Okay, we already have a question coming up. For matching calculation of employee spouse, do you base the calculation on the total gross compensation, the net after solo K deferral, and the wage box of W2? I know the Schedule C owner match is based on the net income. Let's expand that a little bit. I don't think I'm getting the full question. As for, unfortunately, it's not letting me view the rest of it, but the answer is that the calculation for the employee, the spousal of the employee. So if it's a solo 401k, how do you calculate that? Now, to kind of preface this question a little bit, the 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 person is asking, how do you calculate what is able to be contributed to that plan? Now, you're going to have two different parts to that. You're going to have what you add in as far as your employee contribution, which is going to be $18,500. And we'll cover that in a second. Actually, I'd like to skip to another slide real quick before we get into that, because we will get directly into that. If you have any questions, here is how to get in touch with us. And what is exactly an employer-sponsored plan? And that's going to segue into that gentleman's question. It's a plan established for essentially assisting to retain employees to your company. Now, if you are a sole individual, this kind of is a little bit sweeter because it allows you to take advantage of those great tax benefits and deferrals or tax-free growth, and allow you to do it yourself. You don't have to be employed by a corporate job in order to take advantage of those types of benefits. And these things have been around since the mid-70s with the passing of the ERISA Act, the Employment Retirement Income Securities Act of 1974. So these plans have been around for a long time, although you may not have realized you've been able to do this type of investing. This investing as well vested within the constructs of the laws that are written. So it's not anything new or exotic. It's just a different way of looking at things. Now, here's where we're going to get into that question. There's a few key components of an employer plan. There's a business, participants, and contributions. So you have the business. And the question that was asked, let me just pull it up for reference again. So for calculating the employee versus employer calculation for the spouse. So you have to have a business, and the solo 401k allows for you to consider a spouse of a solely owned business as an individual covered by that plan. They don't necessarily have to be a rank and file employee. So with regard to the contributions, you have two different types of contributions that come to a 401k plan. One is made by you as an individual of your income that you are paid. So on your Schedule C of your W-2, your gross taxable wages from that job, you are allowed to defer a portion into that plan. Now, this can be done one of two ways. To the individual's question, you can either make this as your gross or net pay. So if you are getting paid, taking it out of your gross pay, which is going to be before any taxes or anything else is taken out, it is going to be into a traditional 401k, meaning that you're getting a tax deduction and a salary reduction based on that contribution made in. So if you're paying out salary to a spouse and they're making X amount of dollars, you're going to have to calculate that against either of those two numbers, because you can have a Roth or a traditional 401k. Now, a Roth is going to be tax exempt growth, which is going to be after tax contributions, and a traditional is going to be pre-tax with tax deferred growth for those contributions. Now, looking at it, how much that they can contribute, well, you're going to have to look at the limits. So if they're going to be under the age of 50 and one half, they can contribute $18,500 of their gross or net pay, depending on which type of account you're trying to put it into. If they're over the age of 50 and a half, you get a nice kicker in there of an additional $6,000 that you can add in as a contribution to that plan. So that kind of, in a broad sense, tells you how you can contribute for your spouse. But keep in mind that the employee contribution has to be based on how much money they're making. So if you're not paying them out anything, you can't just arbitrarily make a $18,500 contribution to the plan on their behalf. They have to be taking it out. It has to be Social Security qualifying wages that you're basing that on. And then depending on whether you're using gross or net is going to determine whether that is a Roth or a traditional type 401k contribution. Now, the other portion of that with regard to these plans is going to be based on the employer, and we'll get to that in a minute. Now, when I mentioned previously, before we kind of go off into that question, that there are multiple different types of employer plans. Now, what we're going to spend most of our time talking about today is going to be the solo 401k. And a lot of people really like that for a few different reasons, but there are multiple types of employer plans. When we talk about this in the broad context of employer plans, we're really kind of talking about solo 401ks, SEP IRAs, which stands for Simplified Employer Pension IRAs, and simple IRAs. Now, the simple IRA was the precursor to the SEP. It is, in my opinion, very poorly named because it is a very complicated plan to administer and contribute to. A SEP IRA is a much more streamlined portion of that type of plan, and then a solo 401k account is, again, we're going to get into a little bit more in depth for this. But keep in mind that a SEP IRA, and to a lesser extent a simple IRA, are more or less a traditional IRA on steroids. They are all going to be tax deferred contribution plans, and they're going to be based primarily around how much you are being paid with regard to that business. Now, when it looks to how you're going to add money into these plans, there are a few different ways to do it. So you can do a custodial transfer if you have a solo 401k, a SEP IRA, or a simple IRA at another custodian, and you'd like to just move that over. There's no tax reporting inherent with that. It's just a direct movement of cash between those types of accounts. Then people most often talk about moving money with regard to a direct rollover. Now, more often than not, even if you have an old 401k or a self-directed or a solo 401k with another administrator, you're going to be doing this as a direct rollover. Now, direct rollovers can only be done between 401k type plans and IRAs or other 401k type plans. It's kind of a misnomer that it can be done any other way. Any other way where it regards to a rollover is just a regular indirect rollover, and you can only do one every 12 calendar months. Now, a direct rollover is unlimited, but it is reportable. So keep in mind that you are going to be getting reporting from your old 401k plan administrator or 403b, 457, whatever it happens to be, reported on Form 1099 from the IRS. The really important thing to do is when they get that you need to make sure that they have done the correct coding on that, which is code G in box 7 of 1099-R. Now, that means that it is a qualified rollover with no tax implication or withholding requirement due to it. Now, if they do that and they don't have that code, maybe another code with regard to no exemption, you're going to need to make sure that they re-report that, because the 401k can specifically report box 7 code G to make sure that it is reported as a qualified rollover. Just a little bit of tax housekeeping. I know it may be a little bit of a dry topic, but it is important to remember that when you move money from an old 401k, there is going to be a 1099 generated, and you need to make sure that it is correctly reported. Otherwise, the IRS might think you have taken a large distribution, and then not paid any tax on it. All right. So again, the choices of these types of plans, and we're going to get into a more in-depth on this slide of exactly how the contributions are made. So with a simple IRA, and we're going to kind of end into segueing into the next slide with the solo 401k plan, is that a simple IRA is going to be based on a few factors. One, you can defer a portion of your compensation into that plan, and then you can also have an irrevocable election made for 2 years as to whether or not you're going to contribute on behalf of the employee as to a portion of their compensation, or do a across the board profit sharing match of net operating income, which is before tax but after reasonable expenses to that plan. Now, the downside of that is that you're going to have a significantly lower amount that you can contribute on an annual basis versus the SEP and the individual 401k. And the simple IRA, you cannot change that plan or roll out of that plan for 2 full years after the date of establishment, which can make the profit sharing match, if you are making a lot of profit, a rather cumbersome thing to have to continue to do. Or if you have employees that then also want to participate in the plan, but you maybe have changed your business model, can also increase your cost very dramatically if you're using a simple IRA. Now, a SEP IRA is a much more simplified version of a SEP IRA, or a simple IRA. A SEP IRA works well apart from an individual 401k plan, solo 401k plan, and for individuals that are making high amounts of ordinary earned income. Now, when I say that, it's Schedule C, it's earned income, it's Social Security qualifying wages. And the reason that this works pretty well for that is that it allows you to reduce the amount of income that you're showing being paid, create a corporate deduction for that, and then also help to reduce the amount, obviously, that you're showing yourself being paid, because this is going to be strictly a 25% of your total income for that given year can be contributed into a SEP plan on your behalf by the employer. This cannot exceed $55,000. So you have to be making a considerable amount of money in order for this to work, upwards of the neighborhood of about $270,000 per year. But it does work well for those types of individuals. I see a lot of people that make a lot of commission type income work well for them, where an individual 401k plan might not allow them to take advantage of as much deduction, but it does have its place there. And then that $55,000 max contribution is also compounded by the $6,000 or $7,000 individual IRA contribution you're allowed to make on a given year, depending on your age. So that brings your your total contribution amount for that up to $61,000 or $62,000 per year of deductible basis contribution. Now, although a SEP plan does not have a Roth component built in, it does allow for you to do immediate Roth conversions. So you can make that $61,000 contribution, potentially, and then do a Roth conversion that will effectively allow you to get a significant amount of monies into a Roth IRA on an annual basis, so long as you're willing to take the hit for paying your income taxes against the amount of the conversion. Now, any type of Roth conversion is going to be assessed on a 1099 to you directly, 1099-R, that will show that you did a conversion, and then you will calculate that into your gross income for the year, which will be affected by all deductions, credits, and losses that affect your personal income statement. There isn't any type of segregated accounting that you do for a Roth IRA conversion. Now, the individual solo 401k plan. And I say individual K plan, solo 401k, they're different trade names for the same thing. In the most basic instance, an individual or solo 401k plan is just a 401k plan for an owner operated business. Now, I make the distinction for an owner operated business because 401k plans have a unique distinction in how they scale. Because if you have just your owner, or owners in this case, and just the spouse of the owner participating in the plan, you're exempted from a lot of cumbersome reporting requirements, segregation testing requirements, and discrimination testing requirements that are used for that. And when I used discrimination and segregation requirements, it's in the financial sense of how you are treating your employees as regard to their ability to participate in the plan, and how the segregation of funds with regard to deductible, non-deductible employer and employee contributions are made to that plan. And before we jump into this, we have another question. Once a solo 401k is established and the self-employed individual decides to retire, say the age of 70, is the full amount of distributions from the solo 401k taxed at that time? Great question. So with regard to that, the most important thing to look at from that perspective is that with 401ks and traditional IRAs and even Roth 401ks, you have what's called required minimum distributions, which are distributions you are required to take from that type of account once you reach the age of 70 and a half. Now, there is legislation currently in, I believe, the House. I believe there's competing House and Senate bills on this that will raise the age to 72 for you having to start taking your required minimum distributions. Not a huge difference, but we'll take every inch that they give us. So let's say you retire at 70, to circle back to the question. You don't necessarily have to start taking out any funds from that plan at that time. You are only required to start taking out contributions in the year in which you turn 70 and a half, and you can defer that distribution into the end of the year following the year in which you turn 70 and one half. So do some calendar counting and figure out when that might be. Now, you do have to start taking funds out of that. Now, unlike a Roth IRA, which is the one account that's going to be exempted from having to do required minimum distributions, a traditional and a Roth 401k are both going to be required to do required minimum distributions, which are calculated against your general life expectancy according to the IRS life expectancy tables, and whether or not you are married and your spouse's age. So that's essentially what you're getting at with the having to distribute a plan at the age of 70. Even if you retire and you no longer participate, you do not have to do anything with that plan until that year in the age of 70 and one half. Now, there are some strategies to try to get around that. Let's say, and for example, I have a client that has a Roth 401k. He is still working every day and making a lot of money at the age of 77, or he might be 78 now, but he has required minimum distributions from that plan. Now, what he does is he's making only Roth contributions to that account, and he's also converting in plan the employer contribution portion of that, which we'll get into the employee versus employer contributions in a moment. And he's doing all Roth contributions to that plan. Well, he doesn't want to have to take money out of that, especially if he can make great returns and it all be tax free. So what he does is that he does a direct rollover out of that plan after he makes the contribution and conversion directly into a Roth IRA, which has no required minimum distribution requirement. So to generally summarize that question, once you reach the age of 70, you do not have to distribute the account, but you do have to start taking some monies out of that account if they are still there, whether it's Roth or traditional, in the year in which you reach 70 and one half. So, excuse me. So with regard to the two different parts of a solo 401k plan that you have your contributions coming from, think about it like this. The individual or solo 401k plan stands as a third party between you, the business, and the plan itself. So you have money that you make. which is going to be your Social Security qualifying wages. Schedule C, earned income. And in some cases, you can um, use other schedules, but it generally cannot be passive income. It has to be income generated from the business that you are participating in as an employee. Excuse me. Now, that amount of money that you can contribute is going to be $18,500 if you are under the age of 60 and one half, or 50 and one half, my apologies. And then is going to be an additional $6,000 of your earned income that you can contribute when you're over the age of 50 and one half. Now, this is great, but a lot of people say, well, what about the total? I thought I could get up to almost $60,000 in these plans, and you can. The other portion of this comes from that third part, the business. You can take a portion of your net operating income, so income generated by the business after expenses before taxes, and contribute that to the plan. You can contribute up to 25% of your NOI, so that's referred to net operating income, 25% of NOI to the plan per participant, not to exceed $35,000. Repeat that. 25% of NOI, not to exceed $35,000 per participant. This means if you are a solo 401k holder, you can make your $18,500 personal contribution, which is personally deductible to you, and then also a $35,000 corporate contribution as the employer. And keep in mind that you might have a $6,000 buffer in there if you are over the age of 50 and a half into that plan on an annual basis. Now, there's a few other interesting. Oh, sorry, it's not advancing. Now, there are a few other interesting components to this, and I do apologize, I did not update the traditional and Roth IRA contribution amounts on this slide. But if you look at it, you have 25% of your net operating income that you can contribute. Now, I said you can have a Roth or a traditional 401k. Now, that certainly is true, but the initial contributions that you are making into this plan are going to be made solely deductible, meaning solely traditional on behalf of the employer. So that 25% of your NOI is going to be made up solely deductible to the corporation. Now, depending on how you file taxes for that corporation, if you're filing as a subchapter S, then that deduction can generally be passed on to you. You need to get with your tax preparer to see exactly how the deductions would be passed on in this instance. But you can make your personal contribution either deductible, meaning a traditional 401k, so tax deferred growth, or you can take it after taxes and then make it a Roth 401k. Now, that's all well and good, but you still have a large chunk that's being made deductible as a contribution to that. Now, if you are willing to take a additional burden of income in a given year, you can do an automatic Roth conversion of that 25% NOI employer match contribution in plan, meaning that you're saying, hey, I'm going to take that amount of money that the company added into this, convert it, claim it as additional income, and then have the entirety of that plan be a Roth in the matter of the same amount of time it takes for you to make those initial contributions. So it's a good thing to understand that just because you can't initially make the employer contribution Roth, you can make it that way by virtue of utilizing an in-plan Roth conversion. And I teach a whole class on the strategies regarding converting these things to Roths, how it looks for your personal tax income statements, but just understand that the ability of that is there. Now, one thing to really understand about the employer portion, I'll stay on the last slide, the employer portion of that is that if it is you and your spouse, and this has some context to the first question that was asked, if it is you and your spouse participating in the plan and you want to make a contribution of profit sharing to that plan, let's say you have $100,000 for easy math. So 25% of your NOI is going to be $25,000. Then you can't just make $25,000 contributions to each one of your solo 401k accounts. You're going to have to divide that by 2. So each individual then is going to get significantly less. So $12,500 is going to be the maximum amount that you can contribute as an employer into that plan per participant. Now, the flip side of that is that if you have a lot of net operating income, you might be able to get closer to making a max contribution for each individual, or depending on the actual levels of involvement with a spouse, in that it might be easier to maybe not have them participate in the plan, so that way you can get a higher amount of money into an account. But obviously that has a lot of tax planning ramifications and needs to be something that you get with a tax preparer or a CPA in order to make sure that you're making the correct choice. So, with regard to investment options for these plans, they are varied, and we specialize in allowing clients to utilize many different types of asset classes in order to diversify their portfolios. Mainly, our focus is on real estate, but we're seeing a lot more uh, interest in emerging markets such as startup companies, where people will buy private stock or do a convertible note or some other type of investment into a startup company, so that way they can get in on the ground floor and potentially make a large return on their investment by investing in a new emerging market startup company. But real estate tends to be the most popular and has a little bit more of a perceived advantage when using a solo 401k for some of the strategies that you can use for that. But we'll get into that in a moment. But just so you understand, this is very 30,000-foot view of what you can do with these plans. You can get extremely creative with them. You can do many different things with regards to each of these individual investments directly, not just notes and mortgages. You can do second mortgages. You can buy existing mortgages. You can buy underperforming mortgages. You can invest in private stock of any company that's willing to sell it to you, so long as it's not a personally owned business. And you can even do things like single member LLCs, multi member LLCs, limited liability partnerships, limited by liability limited partnerships, which are always kind of a fun couple of letters to tack onto the end of an investment. But just understand that if you'd like to do something with a solo 401k, chances are, so long as it's not going to personally benefit you, there is a way to make that work. Now, I said that these are very flexible plans. They are very comprehensive plans, but there are certain things that you cannot buy with any type of qualified retirement plan. So whether that is a 401k, a SEP IRA, simple IRA, health savings account, if it is a retirement type plan, you cannot buy a life insurance contract, and you cannot buy anything that derives its value from collectability, meaning that if you like to buy baseball cards, a rare bottle of wine, artwork, uh, collectible coins, things like that, those are not allowable investments. Now, there are certain types of precious metal coins you can buy, typically so long as that they are issued by a governmental agency, so long as it's not the South African Cougarand, you can hold those within a retirement plan. All right, we got a question. Yes, you certainly can get a copy of the slides. So long as that you have attended the webinar, I can certainly email those out to you. And if you have any questions, again, my email is Perny, Perny at Advanta IRA, and I'm happy to go over any questions that you might have as well. But thank you for the question. Now, there are certain people that you cannot directly transact with, although the penalties for running afoul of any of these rules is significantly less than what is going to be perceived in an IRA. Now, IRA is listed up here, but I use this slide from another presentation, but the 401k plan owner, the IRA owner, anyone's spouse, so you can't directly buy or sell anything to any of these individuals, your son, daughter, or mother or father. So if you basically draw your family tree and snap a line directly up and down, those are the people you cannot directly transact with. Now, interestingly enough, the IRS does not consider brothers and sisters to be disqualified individuals. So if you wanted to, you could buy a property or buy an asset from your brother or sister, and the IRS is fine with that. The only thing, and I can't stress this enough, is that if you deal with someone that is a close relative, such as an uncle, brother, sister, someone like that, absolutely, and this is very important, deal on a fair market value basis, meaning that if the property would reasonably sell for $100,000 on the open market, if you buy it for 20, or if you buy it for 200, that would be an issue. So make sure that you're dealing on a fair market value basis with these people, but essentially you can. Now, just because you cannot directly deal with these people does not mean you cannot partner with them. We see it all the time where a husband and wife's 401k accounts or IRAs, they will partner together, meaning that they will bring those accounts in together in the initial structuring of the deal, and then purchase it as a joint asset between those two accounts, and then split all of the income and expenses accordingly. So that can be done. So just because you cannot directly buy something from one of these people doesn't mean that you cannot partner with them. A good example of what this would mean for a direct benefit or directly dealing with a disqualified individual, I had a client that had a solo 401k that was looking to buy real estate in Auburn, Alabama. Now, the reason he was looking for Auburn is that, one, it's a college town, so there's always going to be people needing to rent houses. And lo and behold, his daughter was going to be a freshman incoming at University of Auburn. So he purchased the house, and then through virtue of us going through the documents after he had closed and looking at the lease, noticed that one of the lessors had the same last name, asked him about it, and kind of informed him of the rule with that. So it even extends to benefit of these disqualified individuals to your plan assets as well. So we were managed to get it unwound. Unfortunately, his daughter wasn't able to live in the house, but he still got a good investment. But it was definitely a good learning experience because the penalties for doing this kind of stuff, and you're going to see the maybe a potential benefit here between a 401k and an IRA, is that if you use an IRA, whether that's a SEP, a simple, or any other type of IRA account, the penalty, the maximum, or I should say the defined penalty for a prohibited transaction, is disqualification of the entire account, and then the distribution of that deemed on January 1 in which the prohibited transaction had occurred, and they can go back 7 years for these. So let's say that this had happened and then 5 years later they found out about it. He would have had to have claimed the entire value of his, if it was an IRA, as distributable 5 years ago, refile his taxes, pay the penalties, and you're more than less looking at about half of your IRA balance being taken up with that. And specifically, I say IRA. Now, if this were to have occurred within a 401k, prohibited transaction rules for a 401k are the plan does not cease to exist. So it's not a grenade inside the plan. It is a 10% penalty of the value of the transaction per year until it is corrected. And they can go back as far as they want to with that one. So if it is a large transaction going on for a long time, it could potentially be a big penalty, but it is not catastrophic to the plan per se. It is just a penalty in that regard. Yes, you will also receive a link to the recording. Thank you. All right. So with that said, it's a very interesting topic. Now, full disclosure, I do not recommend you do anything prohibited just because it won't inherently grenade your 401k plan. It's better to always run on the right side of the IRS because interesting fact about tax court is that they are not under the burden to prove your guilt. You are under the burden to prove your innocence in that court. So it's a little bit of a different type of court system than criminal or civil court. You don't want to have to be proving to the IRS or the Department of Labor that you are inherently innocent of something they're accusing your plan of doing. It's much easier just to do it right the first time, which is why we're here and we're always happy to help. All right, next slide. Oh, we got a question. Okay, got a good question here. I'm having difficulty understanding my contribution. It has to do with wages. Are my wages the same as Schedule C income? No W-2 issued. If my Schedule C has 50K of income, I can contribute 18 as a Roth and then make company contributions of how much? 50K minus 18K times 25. This is equal to 26. So what you're looking at here is that if you are showing Schedule C earned income from the business that you are operating, whether that is a schedule, whether that is subchapter S or however you're scheduling your taxes. Schedule C is the important thing in here, your Social Security qualifying wages. Now, if you have 50K of income on that, your contributions can be 18,005 if you're under the age of 50 and a half. So you are correct on that point that you can make that directly, and you can do that as Roth or traditional. That doesn't necessarily matter. It just matters, how much money you're claiming as taxable. So you either get a deduction or you don't for the 18.5 of your personal contribution. Now, the company contribution, you're just going to look at the net operating income of the business. So after expenses before taxes. So whatever your NOI is what you multiply by 0.25 to give you the additional amount of money that you can add in there. So for sake of argument, in your question, if you had, let's say 50K was the amount of money that you had in there, then it'd be $12,500 would be the amount that you could additionally add in on behalf of the company to that plan. Because if 50K is going to be the NOI of the company, multiplied by 0.25, $12,500 plus the $18,500, bring it up to what, 27,000 bucks, is what you're going to be looking at for that. Now, again, just using the kind of numbers that you had posed into that, John, it's can vary, and it just kind of depends on what you're showing as NOI, not necessarily just your total income. Now, that can be a little bit of a loaded answer, because if you are filing as a subchapter S and maybe not carrying net operating income of the business and just showing it all as personal income, that can definitely change that. So again, it depends on how you're filing your taxes. It depends on what type of company you're operating, whether that is going to be a subchapter S, an LLC tax as a sub S, a C Corp. There isn't any inherent type of business restriction on what type of business you can have for this. And the taxing election you make of the ownership of that business is going to have a direct impact on which number that you're going to use to calculate that corporate contribution. So again, I do understand that these plans can be a touch complicated to kind of grasp in just the hour or so that I have you. So I do encourage you to reach out once you've had some time to digest it. John, I hope that answered your question as well as possible. So a solo 401k and a SEP and a simple plan, they scale a little bit differently. Now, when I say scale, a solo 401k plan is inherently designed to allow you to have yourself, your spouse, and if it's an owner operated business, covered. 401k plans are kind of notorious for not scaling very well. And when I say scale, if you have a single rank and file employee, a non-equity employee that qualifies, that works for your business, that you pay, that you have on your payroll, you're going to have to do a lot more work for your 401k. You're going to have to employ third-party audits. You're going to have to do what's called discrimination testing, meaning that you have audited financials of that plan showing that you equally uh, apply the rules and offer the plan to those individuals on whether they want to participate in that plan. So that's going to increase your cost of that. With a solo 401k plan, you're exempted from that because owners, spouses, and owner operators are not to be considered with regard to rank and file, so you're exempted from that. So that's why solo 401ks are so awesome, and it gets away from that big expense that 401k plans have. So, if you only have one or two, let's say you have employees, then the plan might not be the best cost benefit. Using something like a SEP or a simple might make more sense, albeit not maybe as powerful as you'd like it to be. But just understand that there is some scaling to look at if you do have employees. Now, a simple plan can cover up to 100. SEPs can scale much farther than that. I believe the 500 point is for SEP plans. And 401k plans do not have any inherent limit, but if you get out of being qualified as a solo 401k, then you are going to have considerably more to do with regard to administration of that plan. All right, Jay's got a question. Can participants in a solo 401k take loans from the 401k up to 50 grand? If they can, so long as the total does not exceed 50, is there a formula to compute available amounts for a second loan while the first is still being repaid? Is it as simple as deducting the current balance of the first loan from the 50k, or are there further limits? Jay, great question. Yes, a solo 401k is inherently governed under all the exact same rules that a bigger 401k is. Now, when you initially establish a 401k, you're going to have what's called your adoption agreement. Now, you as the trustee of that plan that are adopting the agreement, essentially that's kind of a fancy Department of Labor word of saying opening the account. You can make the election of whether or not you want to allow plan are what's called participant loans. Now, for those of you that aren't inherently kind of as familiar with what his question was, typically in a 401k, let's say I worked for IBM and I had money in a 401k, I can go and say, hey, I'd like to take a personal loan out of that 401k, and the HR department will go, great, I'll fill out some paperwork, and then I'll have money out of that 401k. Now, that's not a distribution, it has to be repaid. Now, the rules regarding that are that you have to repay it over a period of 5 years, no more than 5 years, and so long as that loan is not for the purchase of a primary residence. If it is purchased for a primary residence, you can extend that out to 30 years like a typical home mortgage. Now, it has to be repaid over 5 years for most purposes. You have to make at least quarterly payments, 5 years, quarterly payments, and the interest rate that you're paying back has to be a point above or below whatever prime is at the date of taking that loan out. So you can't say, hey, I'm going to take out a $50,000 loan and pay myself 400% interest, which would, be a great way to get a lot of money into an account. You also can't take it out at 0%. Now, there are rules with regards to how much you can take out of one of these plans at any given time. So the rule is that you can take 50% of your total account balance, not to exceed $50,000 at any one given time. So more to Jay's question is there a formula for factoring in how much money you can have out at one given time? And the answer is yes. You can have multiple loans out that, so long as you're not exceeding 50% of your plan balance at that time. So one of the issues might be, let's say you only have $50,000 in the plan, and then, or let's say you had $100,000 in the plan, you've repaid 20 of the initial loans, so you have 30 outstanding, but your securities values have dropped down to a point where that, you can't take out another 20,000 to bring back, or to bring another 30,000 to bring yourself back up to the 50, then you have to go on that value at that time. So when you're looking at it, you can only have 50 out at one time. Now, you have to keep in mind that if you have that out, the maturity dates are still going to be based on each individual loan. And in technical sense, you actually sign a promissory note promising to repay the 401k and yourself personally when you do that. Excuse me. So yes, you can have a maximum of 50K out at one time. There can be multiple loans out, but they're each going to have their own maturity date, their own payment schedule, and you cannot have more than a total of 50 out at any one given time. There's literally actually a worksheet that we send out to our clients doing participant loans from a 401k that you kind of plug in a number saying, how much money do you have? That, and then the final number, the final line is what gives you your available amount that you can potentially take out as a loan. So for 401ks, remember one of the first slides that I indicated is that I'd like you to take away a few things. And one of them was how you can administer these plans. The cool part about them is that not only do you have the ability to have this type of plan with these high contribution limits, but you also get to determine how much of the record keeping you actually want to do for this. So if you want to employ Advanta to be involved in the scenario as the plan provider, we essentially will do all the record keeping, all of the accounting for the assets, the cash of the plan, and you'll just buy and purchase assets directly out of the plan. Now, that is going to be a little bit more expensive depending on what you're doing because you are employing our services for that. And at bare minimum, it's going to be $300 per year for a 401k. Now, let's say you'd like to have total control. You just want to pay us for the plan documents, which is, again, Department of Labor speak for the account, for the compliance document that goes along with this, doing all the periodic updates and keeping the plan in document compliance. Now, that will run $300 a year flat, but you will not have literally any relation with Advanta past just essentially a rental agreement for those plans and the service we provide to that document. Now, that means that you'll hold your own cash account at a bank. You'll get a trust account for that plan. You will record keep all of the assets, all of the cash inflows, any participant loans, any distributions. It's all on you. Now, that can be a little bit daunting for some people, and in full disclosure, doing a DYO is a little bit painful to set up because explaining to John Q. Banker at your local bank what you're trying to do, their head's going to spin a little bit when you say, hey, I have a self-directed solo 401k plan that I need a third-party trust account for. you're going to get a few weird looks. But essentially, I provide letters to my clients that do this, and we get it done. But it is not the easiest thing in getting initially set up. Now, you also are going to be responsible for all the rest of it. So if you're not good with record keeping, it might behoove you to actually pay us to do it for you, and that way it just makes your life a little bit easier, and you're not trying to figure out how to do general practices of accounting for a qualified retirement plan. But one of the big advantages of doing this, as I said, you get to open up your own local bank. So you, as the trustee, inherently have checkbook control. Now, if you haven't done any research on that, sometimes clients with IRAs will set up a new LLC that their IRA will own so they can directly write checks. You can have that ability with a 401k without having to have a second entity that you record keep and pay money to a state to keep registered. You can do it directly with a do your own plan, but just keep in mind that the responsibility of you as the trustee of that plan is much greater in a DYO sense than if you're having us do the plan record keeping for you. So you do get a much more streamlined and cheap service, but you do get less service in that regard. But we're always happy to help answer questions. But most of the time with a do your own 401k, it's not that I don't want to answer our clients' questions, is that I literally have no idea what they're doing, and I just can't offer assistance in most cases because we haven't been involved, we don't have records, and it's just not the service that we're providing to that type of plan. So keep in mind that you do have two different options with a 401k, and unlike a SEP or a simple IRA, you have to have those as custodial accounts. You do have to have a custodian involved in those accounts. With a 401k, you have the flexibility to either do it yourself or have someone like Advana involved in the record keeping of that plan. Oh, thank you, Sarah. I appreciate it. So with regards to that, take that for what it is, and you can certainly go from there. Now, one of the personal coolest things that I think about this, because I'm kind of a geek when it comes to trying to and legally avoid paying as much taxes as possible. Again, tax. I can't remember what I was going to say, but essentially, there's a lot of cool ways to avoid paying taxes in a completely above board way with these types of plans. Now, when I say considerations of leverage, when people look at the base values of looking at leveraging, and by leverage I mean borrowing money in an IRA, and we'll get to a 401k in a minute, is that you run into what's called unrelated debt finance income tax. Unrelated debt finance income tax. It's often referred to as UBIT, or unrelated business income tax. Now, that is a lot of words for a relatively complicated tax, but in most basic sense is that it's a leveling the playing field tax. So when a tax exempt or tax deferred entity such as an IRA borrows money, the IRA is saying, hey, since you're already getting a great tax benefit from this and you're essentially inflating the value of your IRA with this loan, you're going to have to pay tax on the amount of money derived from the leverage. So an easy calculation of this, and I'll kind of show you how big this can be. You buy a $200,000 property with a $100,000 loan and a $100,000 down payment. It's leveraged 50-50. It generates $2,000 a month in rent. So $1,000 a month of that rent is attributable to your basis, the $100,000 down payment. $1,000 of it is based in the finance portion of the property. That $1,000 is going to be taxed at trust rates. So at the end of the year, when you have $12,000 of income for that, you're going to tax it at trust rates, which can be as high as 39 or 38.5%. So it can be substantial, but it does go down when you pay off the loan, and once you eventually own the property, it goes away. The really cool thing about this is that a 401k, and this is legislated in the Department of Labor for the purchase of new real estate, not other assets. So if you're buying real estate specifically and you get a non-recourse loan, you are exempt from that tax. Again, if you buy leveraged property with a 401k, or you're leveraging the property, you pay zero of that tax. So the only thing you're really on the hook for is just repaying that loan and then the interest on that loan. So some of the cooler aspects that I've seen with this are people that do leveraged rentals or leveraged fix and flips, because they don't have that consideration of debt finance tax. Um, that they have to be concerned with. All right, we got a question. Can you explain the trust versus the plan? Why is a trust required? You are doing real estate. What kind of title do you provide at sale? A general warranty deed or a trustee deed? All right, we're going to dissect that a little bit. There's a couple different parts to your question, John. So when I say, and believe you're referring back to when I said trust account for the do your own plan. That can be a little bit of a misnomer because when you go into a bank, you're opening up a record keeping custodial account for a do your own plan. It's most oftentimes generalized as a trust account because you are acting as trustee for the plan. So you don't necessarily have to have a separate trust for this. It's just kind of, there's not really a word for it, so I kind of use trust as a stand-in. But there isn't inherently a trust you have to have. So with a 401k, the plan is in and of itself. You apply for a tax ID number for the plan. The plan itself is an entity. So there isn't inherently a trust required to the second part of that question. So what kind of title do you take to the property? So the property is going to be titled in the name of the plan. Now, you have some flexibility with how you actually name your plan. Typically, a plan is going to be named, such as the one here at Advanta, as Advanta IRA Tampa 401k plan. Kind of bland. But you can, in the interest of increasing anonymity, maybe. So if your business is named Sunshine Rentals LLC, you can name your plan Sunshine Rentals LLC 401k plan. You can also name it whatever else you want. It does not have to be derived from any purpose of the actual name of the business. So for most of the time when clients will open up accounts here, we'll try to reduce that because putting Sunshine LLC 401k plan on, or for benefit of someone on a particular property, can be a little bit verbose. So when you adopt the plan, remember that fancy Department of Labor term for applying for a 401k plan, you also in that adoption agreement say exactly how the assets will be titled under the name of the plan. So the name of the plan can be Sunshine Rentals LLC 401k plan, but the title on all of the assets can be SR LLC 401k. So you can really kind of reduce it down because when you go to closing, you'll take a copy of your adoption agreement, which would be like taking the signature page of a trust agreement or taking the articles and signatory resolution of an LLC to prove that you can sign, and then you convey the property at sale. And then when you look at public record, it would just be SR LLC 401k plan, and then you could have a PO box for the 401k plan so you can remain anonymous like that. And keep in mind that 401ks are not publicly recorded, so you can't necessarily just go to a state registrar's office and say, hey, who's the, kind of do some maybe social media sleuthing, if you will, to try to figure out who's involved with it. There's a good amount of anonymity inherently included with doing it like that. So hope that answered your question, but definitely a very good one. So again, considerations of leverage, and I do understand we're getting a little bit late on time. We had some great questions, so we'll try to get through this. But again, financing with a 401k, you're going to be exempted from that nasty UDFI or UBIT tax. Now, again, remember that that's only for the purchase of new real estate, and if you're buying in a SEP IRA or a simple IRA, you don't get around that. The only employer plan that has to do with that is a 401k. Now, the real important part to remember about this is that it has to be what's called non-recourse financing. Now, if you're not familiar with that, it's really common in commercial and multifamily, not so much in single-family residential. What that means is that when you as the trustee sign that note, the only recourse the lender has in the event of default, so the plan can no longer pay, is to foreclose and take the property to make them whole. You cannot levy a personal guarantee, personal assets. It has to be fully non-recourse. So it's not as common of financing as you would just going down to the local corner bank and getting it. We have a book of business we can refer you, or you can, find private money to do it, but it has to be fully non-recourse. Is a very important thing to remember. Otherwise, it is going to be applied. So this is just kind of a just a little bit more detail on that. The tax form that you file when you do UBIT is called 990T, which is essentially a tax return for a tax exempt or nonprofit entity. And a few deadlines to remember, although we are right smack dab in the middle of the year for this, is that if you want to have a 401k plan, you have to adopt it by December 31st, meaning you just have to sign on the dotted line and say, hey, yes, I'm opening a 401k plan. You have to do that by December 31st. If you had a 401k plan and you want to make previous year employer contributions, you have up until October 16th to do that. And then any of your IRA contributions are going to be the 15th, or the day in which filing falls on. So if you want to have a 401k, you got to at least get that paperwork signed by the 31st. So if you're right in the middle of the year and you're kind of on the line about it, again, remember, you don't have to make contributions to it. You just have to get it open. You just have to say, hey, yes, I am adopting this plan and we're going to move forward with that. So I always like to make sure I respect everyone's time. We came in about 5 minutes early. Again, if you have any questions, type them in. But thank you very much for joining me today. I really enjoy this kind of stuff. Again, I thoroughly do enjoy actually helping people get into something that's going to be a good fit for them, and making sure they can avoid paying unnecessary taxes whenever possible. So again, thank you very much. If you wanted slides, if you attended today, I can make sure those go out to you. Or if you have any direct questions, always feel free to give me a call or email me directly at my contact information here.